shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important, and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
Just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning. Good morning. How is everybody on this fantastic Thursday morning? It's very wet and rainy here in Nashville, but wherever you are, I hope things are going fantastic for you. It's the middle of the day for those of us in the middle of the country. Those of you on the East Coast, 1 o'clock, and those of you on the West Coast, it's still morning for you, so I hope you're doing fantastic. Today, I'm looking forward to getting into a topic that should be near and dear to everybody, and that is how to avoid a market crash. We're in the middle of a lot of volatility right now, and it felt very appropriate to talk about this, so that's what we're going to spend some of our time talking about today. How to avoid a market crash, and this is relative to you if you are a crypto trader, if you're a stock trader, if you're trading for your retirement, whatever it is that you're trading. Everything I'm about to teach you over the next 20, 30 minutes here after our market update, everything is completely relevant for you. And so I'm looking forward to sharing it with you, and I know you're going to enjoy it. And you've probably got some friends or family members who've been sitting here through the middle of this bear market, and they're kind of panicking a little bit. Maybe they've been watching the news. They've been watching some of those people that are out there stirring fear, and they're like, oh, we don't know what to do. Well, just send them the link and tell them to come over here and watch, because I'm about to tell you exactly what to do. But before we do that, we're going to get over here and take a look at the live market and see what is going on. It is down. Excuse me, it is not down at all. I didn't even mean to say that. I don't know why I said it's down. The Dow Jones, what I meant to say. The Dow Jones is up 425, 423 this morning as we get going here. 427. Continues to move for us here. But the downtrend has not necessarily reversed yet. So this trend that we've been watching is part of what we're going to be talking about later today. This trend we've been watching got established at the beginning of March. And so far, it's holding strong. We are holding at this pivot point, at this resistance level. We had a lot of selling that came in yesterday, that long upper candlestick shadow. We actually talked about that when we talked about candles yesterday. And if you didn't watch that session, it was a really good one, I think, in terms of interpreting candlesticks and learning how to read them, apply them to your current trades. So pretty much what we talked about yesterday is coming true today. All that selling pressure, all this pivot area is providing that downward pressure. And as it provides that downward pressure, I think we're just going to stay stuck right in here, which is really a miserable feeling. But I think we probably got a week or two of this. Now, there's a couple other ways it could go out. Could shake out, I should say. One way is that we just rally from here, and this green candle turns into more green candles, and maybe we hit this pivot and we kind of bounce in here. Moving averages get all caught up, and eventually we trend to the upside. That would be nice, and that may be exactly what happens. But the other way that it could trade from here is that it could just simply fall. And right now, we do not have a direction. Right now, we are about as neutral as you can be, completely flat, indecisive. We don't know exactly what's going on. That's why we have these 400-point days to the upside, 400, 500 points to the downside, and it's back and forth, back and forth. Now, I don't want to strike fear in anybody, but I'm going to tell you this is exactly what it looked like in 2008. Back then, before the big market crash, before the big real estate crash, we actually had several months of buildup to that, and it looked very similar to this. It was not quite as volatile this early in the year, back in 2008, but eventually we got there, and it was very similar where we would have 400 or 500 points to the downside, then 400 or 500 points to the upside. It's back and forth, back and forth. And that market volatility is very intimidating to a lot of people. It's actually the reason I'm doing the session I'm going to do today is because market volatility is so scary to people. So What I want to leave you with here is be vigilant. Be vigilant. Don't be assumptive. Don't assume that the market's going to come back. Don't assume that if you just buy and hold it, that we're going to bounce from here. It might happen, but be protective. You know, if the market does decide that it's going to continue selling, don't hold all the way into the toilet. You know, don't be that person. There's no reason for you to do it. In fact, we had the sell signals over a month ago, so you should already be into a cash position or maybe taking some bearish trades. So that's my message to you. Just, you know, be vigilant here. Don't sit back and just assume because you've heard for years that the market always comes back. Don't assume that that's going to be the pathway. It might be the pathway, or it could easily be the opposite story as well. So that's my message there on the Dow Jones. Let's take a look over here at the S&P and in the NASDAQ. S&P is up about 93 today. Same thing. It's a little bit different. It is building a pivot here, a relatively new pivot. We don't have a lot of lines in this area here, right around 5,500. But you can see that this is exactly, if you can see my cursor here, this is exactly where we found resistance about the last 2 weeks, a couple times in here. So that seems to be what we're pushing into today. I said this, can't remember if it was yesterday or the day before, kind of the way that I'm looking at this bounce in here, I think we're going to see our stochastics get to overbought and then make the turn. And then we're either going to stay stuck here or we're going to actually trend to the downside. Now, I'm kind of cautious about that because the reality is there's a big part of me that's very bullish right now. We just are not seeing the momentum behind the bullish trades. So that's what I'm trying to be cautious about here, is let you know that there's a part of me that's very, very optimistic. There's another part of me that says, well, we just don't see it yet. And we certainly can't take a big bullish position based on today's candle necessarily. Just there's too much indecision at this point. Taking a look over here at the NASDAQ, basically the same thing. Basically the exact same picture here. We are running into that resistance that we had intraday back last week, last Wednesday, and then actually I think it was 2 Wednesdays ago, and then Monday the 14th. So a couple of resistant points there, and maybe this is it. Maybe we'll build out from here, but so far the trend is bearish. That's the point here. You got to make sure you realize the trend itself is still bearish. The trend itself has not reversed. So while it may not be time to go bearish, it's not time to go bullish. That's what I can say emphatically. I can't say for sure if it's time to take bearish trades. I can say it's not time yet to take bullish trades. And that's really the message that we've got right now. It's where we've been for the last several weeks. It's why if you've been following our ETF portfolio, it's why we have been sitting in cash, because we're just sitting there waiting the storm out. And sometimes that's the best thing you can do. All right, that's my big picture market update. I don't think there's anything major in there left to talk about. And I got a fairly decent size slideshow to get through today. So I want to jump right in and talk about how to avoid market crashes. And again, this is relevant if you are trading crypto. It's relevant if you're managing a retirement strategy. It's relevant whatever market you're trading. It was the great Mark Twain who once said, "The return of my money is more important to me than the return on my money." Good old Mark Twain, Samuel Clemens. And it's true. The return of our money is what most people obsess about. That's what they care about, which is why when we get into a market condition like we're in right now, and we have all this market volatility, people freak out. It's human nature to freak out when we have market volatility. It's human nature. One of the things that I've learned in my 26 years of trading is I've learned how important the understanding of human behavior is in terms of anticipating and managing your trades. Human behavior is something that honestly in a school environment, growing up through the education system in America, we were not taught very much about. But as I grew up and got into trading and then ultimately business, I have discovered that human behavior may be the most important discipline of all. To learn what the behavior is going to be in the case of the market, learn the behavior of the people that are trading the market. In the case of business, learn the behavior of the people that are buying your products or selling your products and the way the market behaves. It's such an important discipline, and I think it's a huge gap in our education system, right up there with not understanding finances itself. It's just kind of like they took two of the most important topics and replaced it with some of the most boring topics. But we'll save that conversation for another day. The point I wanted to make here is volatility will freak a person out. You might say, well, what is it? What causes it? Really simply defined, here's how we're going to define volatility. Volatility is the wild up and down swings that you experience when you're trading the market. The wild up and down swings. So if you've been trading crypto, if you've been trading, just looking at your retirement account, you've been watching the news and seeing the big swings up and down lately, you might notice a couple weeks ago, we were down 7% in one afternoon. It was huge. I think it was about 3 weeks ago, we had 3,000 points of volatility in one day on the Dow Jones Industrial Average. That's a huge intraday swing. And this volatility is enough to knock anybody out. It pushes your stop orders out. It messes you up emotionally. It's just a mess, right? And so what ends up happening, I want to show you a chart here. This is Bitcoin. What ends up happening is people can't stomach it. And this is a big picture. This is a big picture, big picture overview of Bitcoin since about 2019. I just want to show you how much volatility is in Bitcoin, which, by the way, whether you realize it or not, is one of the more stable cryptocurrencies. Believe it or not. But here's where we've been. In 2020, Bitcoin was up 600% before it crashed. Then it was up 100% before it crashed. Then it was up 320% before it crashed. Then it was up 100% before it crashed. Now, if you look at this from a big picture standpoint, if you zoom way out like I've done, it's easy to see that picture and say, well, over time it goes up. That's the easy thing because you're right now very dissociated. You're looking at it and you're saying, see, over time it goes up. If I just buy and hold, everything's going to work out. But in the moment of the trade, what you have to realize is you're not looking at a 5-year picture. What you're feeling in the moment of the trade is, hey, I was up 600% and boom, now I'm down 50%. Boom, now I'm down 65%. Boom, now I'm down 28%. Now I'm down 30%. And those 30% swings, while it might just sound like a number to you right now, if you're trading a large amount of money, is devastating. It's absolutely devastating. A 50% swing is almost twice as devastating. 65% swing is more than twice as devastating. And that's why people get so scared about trading crypto. For those of you who have not traded crypto, it's these volatility swings that freak you out. For those of you that are trading crypto, it's these volatility swings that lead you to really, really bad trading philosophy and trading strategies, which we're going to talk about here momentarily. But let me just put it in perspective. If you had $100,000 of Bitcoin at the peak in 2021, after the sell-off, you were down $50,000. Just let that sink in. For most of you, $50,000 is a sizable amount of money. When I first started coaching in crypto, I'd been trading it for a little bit, but I hadn't really been super active in it. And I ended up with a coaching client who reached out to me. He was actually from overseas. He'd been in crypto for quite a while. He did extremely well during this 600% game. He had a lot of positions. He made over $1 million, almost $2 million in this move during 2020. So during COVID, while everybody's freaking out, this client of mine made over 7 figures. And then what do you think happened as Bitcoin tanked? He held until he couldn't hold anymore. And for him, the number was about 700,000. You might look at it and think that's 50%. But for him, the guy who had ridden the ride all the way up and watched it come back down, when he was down 700,000 from the peak, he said, I can't do it anymore. And he sold his positions. Now, he still had a good gain. He had a very healthy gain. And he was excited about that. But he didn't really look at it and say, man, I went from, 150,000 and I walked away now with, 720 or whatever it was he had. He didn't do that. Instead, his mindset, because he's a human being and he has human psychology, his mindset was, I had almost $2 million and now I'm down to just over whatever it was. He was down 700,000. So I guess down to 700, 750, something like that. Because that's what his drawdown was. Well, then what do you think happens in that psychological moment? When he's just had this incredible gain and then an incredible loss, psychologically, did he jump back in for the next 100%? The answer is no. He didn't. He was paralyzed, just like most traders. He was paralyzed and he did not take advantage of the next 100% gain. And he started to work with me towards the end of 2021, the beginning of 2022. But I am happy to say that he was prepared for the 320% because we coached him through it. And what I'm showing you and what I'm trying to impress upon you is an understanding that market volatility can be your worst enemy or it can be your best friend. But if you don't understand it, it will beat you up like a kid behind the dumpster on the playground. I just came up with that metaphor. How do you like that one? All right, so the solution for a lot of people, when you zoom way out, you look at a 5-year perspective, you say, well, it goes up over time. The solution for most of you is you say, well, that's easy, buy and hold. Buy and hodl. Hold on for dear life. That sounds great, but the problem with hodl is this. Starting when and ending when. Starting when and ending when. When do I start holding and when do I complete my holdings? And if you listen to most crypto enthusiasts, they're going to say you hold forever. But there's just one problem with holding forever. I need the money. At some point, the whole reason you invested in crypto, the whole reason you invested in stocks or whatever it is that you're buying, the entire purpose for getting in is to make money. If you're buying and holding forever, when do you make your money? When do you actually get to go, have a lifestyle upgrade? When do you get to buy nicer things for your kids or take the extra vacation or whatever it is that you're wanting to do? You see, if you bought and hodled Bitcoin during this time period, yes, you made money. Of course you made money. But you also went on a 5-year journey of an emotional roller coaster, one that most people do not have the gonads to endure. That's the reality. And there's a bigger problem here as well, and I'm going to share it with you right now. The bigger problem of buy and hold and this idea that if you just hold on long enough, everything will go up. The bigger problem is most people don't buy when it's cheap. Most people end up buying at the top. How do I know that? It's easy. Number one, I coach them. Number two, and more importantly, it's easy because you realize people want to buy the thing that they're afraid of when the news media says it's safe. And when does the news media say it's safe? Only when they're reporting it's really high. So, for example, you look at some of the meme coins. Not too long ago, we went through a really intense cycle of this. Back around the inauguration, Trump and his crew, they put out all these meme coins that were surrounding Trump, and they had a Melania coin and I think a Don Jr. coin. I think they did one for everybody in the family, probably including the dog. Who knows? But, these coins overnight, they're up 10,000, 20,000%, and it attracts all these people into it. And people are trying to figure out, well, how do I buy this coin? Well, it's built on Solana, so I got to go buy some Solana first. Got to go to a certain exchange. You got to, transfer it over here. They were just so desperate to get a hold of the Trump meme coins. By the time they finally got them, what happened? It all tanked. Because the time to buy it was not when the news media was reporting on it. The time to buy it was when it was low and it was about to go high. Even though Bitcoin is established now, Bitcoin has the same problem. And it's not just Bitcoin, it's actually every asset. When do people want to start buying the market? People who just survived the last recession, people who just got through, they finally feel like they got their feet under them again. When do they want to start buying? They start buying when the media says, hey, the market's at all-time highs. It's going to keep going this time. And so what do most people do? Most people end up buying at the top. And then they end up selling when we're down in one of those 50% or 60% sell-offs. And instead of realizing a 100% gain followed by a pullback, what they realize is as soon as I get in, the market crashes. As soon as I get in, it goes down. Maybe they had the courage and they bought $100,000 worth. And sure enough, as soon as they got in, within 3 months, it's worth $50,000. Now tell me, your own behavior. If you buy something and within just a few months of buying it, it's down 50%, it's down to $50,000, you bought it for $100,000, are you going to hold it? through the storm. You're going to buy and hodl forever. Some people will. Some people will. I have a friend that did this during the 2022, if you can see on the cursor here, during the 2022 crash. He bought what I thought was a little expensive. He actually came into some pretty good money from somebody in his family, and he was able to afford 3 whole Bitcoin. He bought it for around $60,000. It was about $180,000 that he put into it. Well, guess what happened? You can see on the chart here, 60,000 in 2022 went straight down to 20,000. So he held all the way through it, and now he's finally doing fine. But I've been kind of watching him and his emotional turmoil during this time period as he went through 180,000 that turned into 60,000. Now, in his case, he had the gonads to hold it out, mostly because he was just afraid to sell it. And in crypto, especially in Bitcoin, that's become kind of the thing. People just say, well, just hodl, just hold on for dear life. Eventually it will get there. But it's not reality. It's not always the case. Sometimes it's the case, but it's not always the case. And I know you're looking at you and say, well, it sure is the case there. No, it's not always the case. And I'm going to show you another chart in a moment that will help illustrate why this is not always the case. Okay? What I want you to understand right now, the key point of this is that most people don't actually buy low and sell high. Most people buy high and sell low. And they're always upside down. And the principle you need to understand is this: human beings will do more to avoid pain than to gain pleasure. Human beings will do more to avoid pain than to gain pleasure, which is the reason that we have some of the psychology that happens in the market to begin with. Number one, they wait too late to get in because they're trying to avoid the pain. So they're saying, I don't know, it looks risky. I don't know, Bitcoin has nothing backing it. There's nothing that's holding on to it. Why would I buy it? There's nothing of substance here. And then suddenly Bitcoin breaks 100,000 and people say, you know what? I think I need some of that Bitcoin. Let's go buy some Bitcoin. At exactly the wrong time. How many people do you know that just a few months ago it was over 100,000? They're like, yeah, let's buy. And then before you know it, 3 months later, it's down in the 60s and 70s and 80s. Once again, buying at the top, stuck in the bottom. So the second thing that happens, first thing is people just because of their fear of pain, they wait too late to get in. The other issue is they sell early. When they finally see all that pain, they're like, oh, I can't take it anymore. And they flush it out and they close their trades for a loss. And then there's a few out there, there's a few bellwether stalwarts that will stick it out. And they say, you know what? I'm in all the way, hodl till the end. And they have been rewarded. They have been rewarded, but not without great emotional duress. So here's what we see people do during market turns, or just during all of this in general. They get burned and they run. Once they get burned, they run away. Or they hodl and they hide. They hold on for dear life and then they just go into hiding and say, how can I avoid this? Or here's what they do next. Instead of taking big risks, they take small risks, which means they get little rewards. And I want to talk about this one for a minute, because here's what I see with Bitcoin. People will say, Bitcoin's really volatile. I'm just going to put $100 over there. Okay, great. I'm fine with taking a small risk, but here's what you have to understand. If you buy $100 worth of Bitcoin and it doubles, you only have $200. You made a $100 profit. I mean, that's barely enough to go out for a nice steak dinner. It's probably not enough depending on where you live. Small risks lead to small rewards. And people realize that. They realize, well, okay, I bought my $100 worth of Bitcoin and it didn't really change my life. So then what do they do next? They say, okay, instead of buying Bitcoin, I'm gonna go cheap. I'm gonna buy penny stocks, or I'm gonna buy cheap meme coins, or I'm gonna buy, the really inexpensive cryptos that are less than 20 cents, and they have the opportunity to, go up 10,000%. And that's great too, except for when they don't do anything. So you're hodling nothing. Or what other people do is they do a combination of all this above. Okay. Now I get it. All of this is natural human behavior. All of what I have just described is human behavior. And in crypto specifically, I'm talking a lot to crypto today. In crypto specifically, what we see is people say, well, I can't afford as much Bitcoin as I want, so I'm just going to put $1,000 in 10 different cheap cryptos and hope one of them hits. That's gambling, folks. That is gambling. There is a better solution. There's a better way. And the real solution and the real way to do this is to learn to trade it. So let's walk through that a little bit here, and I'll show you how we time the market and how we avoid the big drawdowns, okay? How do we trade it? Well, here's how we trade it. You buy low and you sell high. I mean, this is easy. This is what most people intuitively understand. They just don't know how to do it. But intellectually, it's easy to understand. If I can buy at one price and sell at a higher price, I'm going to make a profit. And it doesn't matter if you're trading crypto, if you're trading, QQQ, if you're trading SPY, if you're whatever it is that you're trading, stocks, options, futures, forex, the same principle. It's the exact same concept. You just want to buy it at a cheaper price and sell it higher. It doesn't matter if you're trading cars. Shoot, same principle. If I can buy a car for $1,000 and sell it for $1,500, I made a profit, right? This is basic. This is basic. But what does everybody say whenever I say, oh, you just got to buy low and sell high? The HODL crowd in particular, they say, oh, but you can't do that. You can't time the market. You can't do it. And what do I say? Hey, stop it. I say, stop telling me what I can't do. You can't time the market, but I can. Don't tell me, just because you can't do it, don't project that on me and tell me I can't do it. But what most people do is they listen to outside voices. They don't trust themselves, and they don't trust that they can time the market if they just have the better system. They have the techniques to do it. So let me show you. How easy would it be to time the market? Well, here's how easy it could be. This is the same trade on SPY, and notice it's green and red. This is a little indicator that we created that we put in TradingView, and it's as simple as green and red. So when it turns green down here, you buy, and when it turns red up here, you sell. When it turns green down here, you buy, and when it turns red up here, you sell. Now, I know if you're going to be really nitpicky about it, there's a few others in here where it turned green and then red, and it was basically a break-even trade. They weren't big losses. If there was any loss, it was very small. But this system will get you into the big part of the trend, and it will keep you in the main part of the trend. And it's as easy as learning to read the chart. You say, well, that's the stock market. That's the S&P 500. I want to trade crypto. Great. Let me show you crypto. Here it is on Bitcoin. Green and red, green and red. We get in when it's green. We get out when it's red. Now, going back to 2020, we could have gotten into Bitcoin at just over 10,000, and we get out, depending on exactly how you choose to execute your exits, you're going to get out roughly around 50 to 55,000. Now, I don't know about you, but 500% ROI on some Bitcoin where I didn't have to have a 50% drawdown sounds pretty good. But inevitably, here's what people say. Oh, but I could have gotten out at 60. No, you couldn't have. See, that's where we're going to disagree. You say you can't time the market, therefore I can't time it. And I say, no, it's not true. I can time it. You can't time it. Then you say, oh, but I didn't get out at 60. No, what I'm going to say is you can't get out at the top. See, people have this delusion that they can actually get out at the top. And you get to do it once in your life. And once you've done it, you don't get to do it again. So if you've done it, then congratulations, you've already burned that one. If you haven't done it yet, great. One day you're going to get out exactly at the top and you're going to feel proud. And now it's gone. That's not repeatable success. But what is repeatable is what you're seeing on the screen here. What is repeatable is to get in just above 10,000 and get out as the trend is breaking right before the 50% crash. To get in July, back in around 35,000 and get back out around 55, 60,000 the second time. And to avoid all the big pain of the 65% sell-off, get back in the beginning of 2023 around 20,000. If you didn't have the gonads to do that, you may have traded that, made a small profit and got back in, or maybe you just held it, or maybe you just didn't wait until the end of 2023. But however you chose to trade this, you get back in around 25, and then you're out at 60, you're back in around 60, and you held it through about 100, and you've avoided the most recent trade. And it's not hard. It's not hard. It's just that most people don't have the courage to do it. Or they talk themselves out of it with some ridiculous excuse, such as, well, I'm going to have to pay taxes on that. Really? So we're just going to be terrible traders because you're afraid of paying taxes? Oh, I'm just going to buy and hold. It goes up. It always goes up. But think about your opportunity cost that you lost, and think about the emotional roller coaster, and be really honest with yourself. Do you have the courage to hold through? If you have a large sum, if you have 100,000 or 200,000, do you have the courage to hold through a $50,000 drawdown or $75,000 drawdown? Do you really want to look at your account and be like, man, it's upside down, $75,000. Oh, I'm happy, hodl, hodl. Hang on for dear life. Most people don't have the courage to do that, and you shouldn't. Moreover, what if you had taken that first 500% profit, and when we jump back in, instead of buying, let's say that originally, well, it's hard to say. Let's just say you started with 1 Bitcoin. So you had 1 Bitcoin, you bought, we'll say 10,000, you sold it for 50 or 55. And what if now you could buy back in just above 30? Now you're not buying 1 Bitcoin. Now you have enough to buy about 1.5. Whoa. And the next ride up, now we didn't just go from 35 back to 60, which we did make the move, but you did it with not 1 whole Bitcoin, but with 1.5 Bitcoin. And so you doubled up on your profits almost. And then you avoid that 65% drawdown, and we get back in. Now you've got enough that you've got 2 whole Bitcoin, but the price has dropped. And now that we're down to 20,000, maybe you can afford 3 whole Bitcoin because you've profited so much. And so you buy 3, and now you ride the next wave up, the next 300% gain with 3 whole Bitcoin, and we sell at just over 60,000 this time. But this time we made 40,000 per Bitcoin times 3. Not times 1. You see, one of the problems with hodling, one of the problems with buying and holding is you cut your profits short. You're not selling for a profit and reinvesting at a cheaper price. When you buy and hold, you're just hodling. You're just holding on for dear life. But you can't time the market, Jeremy. But you can time the market. When you know how, when you have the tools, when you have the charts, and you know exactly how to do it, you can absolutely time the market. So don't listen to those people who tell you you can't do it. Now you might be thinking, well, what about for a cheaper trade? Maybe like XRP was really, really cheap and a lot of people jumping into it. It's got a big cult following. Or maybe some cheaper stocks. You say the stocks are too expensive. I can't buy Netflix or Nvidia. They're too expensive. Okay. Well, let me show you XRP. And this one I really hold dear to my heart because I've been in XRP many times for the last 5+ years. I bought my first XRP in, I think, 2019, 2018. I bought it for less than 20 cents. That was my very first XRP that I started investing in. And I've been in the community for a long time, and I've been listening to people talk about XRP and talk about how wonderful it is. And I agree. I like XRP. But it's not the trade that some people have made it out to be. And it's hard to say, you know, who started some of the rumors. I mean, some of it's just been online forums where people, you know, just kind of create circle tell and come up with their own forecasts for it. Some of it's been legitimate. Some of it has been substantial. But, you know, there's a big group of people that are out there saying XRP is going to replace Bitcoin and it's going to be $100,000 in XRP. All you have to do is buy XRP and you're going to be rich. They say buy $100 worth of XRP and eventually you'll be a multimillionaire. Well, this is not right. So I know people who have bought in these peaks and they've held through the valleys, just literally hanging on for dear life, and they miss this incredible opportunity. So I know people, when I ask them about XRP, they say, oh, that's a bummer. Like, it's a terrible crypto. It does nothing. And that's all their perspective is. When I look at it and I say, hey, it's done really well for me. I'm going to say this on camera. I've said it many times before. I've never lost money on XRP. I've never lost money on crypto. Strangely enough. That's not completely true. I did buy some meme coins one time that I shouldn't have. And okay, I put $100 into some meme coins one time and I fell for it. I didn't really fall for it. I just wanted to see what would happen. And what happened was not what some people said happened. But in terms of actual crypto trading, I've never lost money on crypto. It's really actually quite easy to trade if you know what you're doing. It's remarkably easy. But if you buy and hold, you buy and hodl, you're going to be frustrated. So here's what happened. Back in 2021, XRP had a really big move. And we went from about 25, 30 cents up to, we peaked out about $1.80. Now, I didn't sell at $1.80. I sold over here at about $1.50. That's when I sold. So I had my original bag of crypto that I paid less than 20 cents for. I'll make it full screen so you guys can see it. I had my original bag of XRP that I bought for less than 20 cents, and I was able to make about a 5x profit on it. Here's the crazy thing. At the top up here where you see it says sell high, the majority of the average everyday people I know that bought XRP, they bought it up here at the top. And then they held it through this valley. I didn't. I just stayed out of it. Now, to make matters worse, they've bought into this philosophy, this idea, if I hold it long enough, I'm going to be rich. So when it bounces again, they actually bought more on the way back up. So I know many people who bought the first round around $1.50, $1.60, some at $1.80. And then they bought more the next time on the way up, thinking it was going to be going up to thousands. And then they held all the way through this, this absolute calamity here. From 2022 all the way through 2024, XRP was basically a dud. There was a couple of times where it spiked, but they're tied up in this SEC lawsuit, had all these problems. And I know people who literally, I can tell you names right now, had thousands of dollars tied up in XRP that they were upside down in. They had bought, in one case, $50,000 worth when it was well over, $1. And then they watch it come down into the 40 and 50 cents. So they're looking at this, and their $50,000 bag is now worth less than $25,000. They're like, man, this thing's a bummer, but one day I'm going to be worth $1 billion because I got XRP. Hang on. And then, of course, it spiked in July of 2023, and everybody was all excited. Then it came right back down, and it stayed stuck. Well, guess what happened last fall? We started seeing signs that it would be time to buy again, and my people in my Sunday night class, they can verify this. I started telling them, hey, it's 35, 40 cents, 45 cents. I was like, hey, we're getting ready to move. We got all the signals that have primed up for XRP. And we started taking positions again, and we rode it all the way back up. This time it peaked at 340. We ended up getting out. I sold most of mine around 260, 270. And I have taken a very small position again, but I really don't think it's time yet. I just went ahead and took a very, very small position. But most of the people I know, guess what? They did not ride that trade. Instead, I actually still, as recently as yesterday, got a phone call from somebody who said that they're ready to start buying XRP. They know that it's going higher. They know this is the future. Tell me, what do I not know, Jeremy? One of the things that inspired today's talk. And what I told them is what I'm going to tell you. XRP is great, just like most of the other cryptos are great, but you got to recognize the right timing. I wouldn't want to be telling them, here's how you go buy it, if it's not the right time. And that's what I would say to you, and I would say to anybody else. There's no bad cryptos, really. There are, I guess, but as long as they're moving, as long as there's volatility, you can make money with them. You just got to time it better. You got to know when to get in and when to get out. Okay. So what are the benefits of trading like this? The first big benefit is you avoid the big drawdowns. The next one is you double down on your wins. We've already talked about that. You double down with doubling up on your profits. The next one is you get to reallocate during the down cycles. Reallocate during down cycles. So when the market's down, like the picture I just showed you with XRP, and it's down for 2 years, you don't have to sit there and hold a dud. Take that money and go reallocate it somewhere else that is performing. Because during that same time, Bitcoin did better. During that same time, Solana did fantastic. There was a whole bunch of other cryptos that you could have put the same money into and done much better with. Another benefit of trading like this is you get to withdraw your cash if you need it. Okay? Take some money out. Take the kids out. Take the wife out or the husband. And most importantly, you get to avoid the emotional trauma of the drawdowns. So you might be thinking, well, if this is so easy, why don't the pros do it? And here's the answer. They do, just not your pros. The real pros, the ones who actually are managing real money the right way, they do exactly what I'm teaching you. But the pros that most people are hiring, they don't do this. The pros that most people hire are your average and I don't want to just name brands, but I'm gonna say it just so you know. Your average everyday fund manager at your typical Edward Jones branch, your typical Fidelity office, or your typical everyday retail trader, retail banking customer who goes in and says, hey, I got a little bit of money and I want someone to manage it for me. Those professionals notoriously do terrible. You say, how bad could they do? I'm going to show you. Over 15 years, according to the Spiva study, over 15 years, only 10% outperform the S&P 500. That means 89%, let's just round it to 90% cannot match or beat the market. That's why I say your pros can't do it. Now, here's the crazy thing. They stopped publishing the longer data. Over 20 years, that number cuts in half. It's only about 5 or 6% that actually outperform the market over 20 years. Kind of crazy. And so if you've been looking at your retirement funds, you've been looking at the money that you've got under management, you're like, man, it just seems like it's kind of staying flat, because it probably is. It probably is. The pros just aren't that good at their job. That's just the reality. Most of them aren't. Okay, and this is a study, they've been updating this for years. I've been tracking the study for years. Never changes. I mean, it changes a couple percentage points here and there, but all things considered, it doesn't change. So what should you do? How should you handle it? Well, my answer is easy. You learn to trade. That's the obvious thing. And your first reaction might be, well, I don't have time to learn to trade. I don't have time to manage on my own. And I'm going to say to you, I'm calling BS, because let's take that Bitcoin trade, the one from 2020 to current, over 5 years. If you took every major signal on here, you would have only placed about 5 or 6 trades. That's on average 1 per year. You're telling me you don't have time to do 1 per year, 2 per year? You don't have to trade. You don't have to day trade. You certainly don't have to day trade. You don't even have to swing trade. You just need to learn how to get in at the major trends and get out when the major trends are reversing. And if you learn how to do that, you'll be in great shape, and you can avoid the type of volatility that we've been stuck in for the last month and a half here. But let me show you how much it's really costing you, because I know at first glance people are like, it's too much work. I don't know. I'm not confident. I know you're not. But let me show you what it's really costing you to be somewhat passive in your trading. To say, I'm just going to buy and hold, or to say, I'm going to trust another, so-called professional and let them manage it for me. Here's what it's costing you. First and foremost, you have huge market drawdowns and you're stuck riding them. That's an emotional roller coaster. More importantly than just the emotional piece, your account is underperforming. It could be doing at least 50% better, probably more. By simply selling at the top and buying back in at a cheaper price, you can way outperform. The third thing that it's costing you is your lost opportunity. Look at the other trades that you could have taken that you didn't because you were hodling XRP or you were hodling an underperforming asset. And it doesn't have to be XRP. It's just the one I'm picking on today. But it could have been gold during the years that it wasn't doing so well, or it could have been anything else. People get so married to their investment that they can't let go of it, and then they end up missing the opportunities. Moreover, your money's tied up. Your money's tied up, and you end up with this feeling of, I can't control the market. The market's out of control. It's working against me. You say, well, okay, I get that. How much is it costing me to have somebody else manage it for me? I'm so glad you asked. What are the pros costing you? They also underperform, as you have seen, but the difference is you're paying them 2%, generally speaking, 2% per year of, not of your profit, of your account. And they get paid even if they stink. So what does that translate to you? Well, let me show you what it translates to you. Let's say that this year you had put, we'll say, $100,000 into money under management. Or it could be $1 million, whatever it is that you've got in your retirement. So you take it over to your typical advisor and you say, here's my $100,000, go put it in the market. They bought it beginning of the year. They didn't sell high. They held through this. Well, here's what happened. We got our sell signal, and everybody who's in my Sunday night class will validate this. We have it recorded as well. We got our sell signals on the QQQ is around 520. So that's when they should have gotten out. Most of them didn't. At the worst point, a week and a half ago, we were down to 410. That's a 22% drawdown. Now, I don't know if any of you sold at the bottom. I don't know if your advisors sold at the bottom. They probably did, but who knows? I do know that the media itself doesn't even start talking about the bear market or the recession until it's down about 15 or 20%. So about over here, when you're already feeling a whole lot of pain, if you can see my cursor here, that's when the media starts talking about it. Well, here's what it translates in real numbers. If you put $100,000 at the beginning of the year, by the time we got done about 2 weeks ago, your $100,000, just in 2025, your $100,000 was down $22,000, but you're still paying your annual management fee of $2,000. 2% of money under management, that's what you're paying. So just taking the time to learn how to do what I'm teaching you today could potentially save you $24,000 of pain. What if you had a $250,000 account? Or a $500,000 account? Or $1 million? If you had $1 million and you just went through a 22% drawdown, you looked at $220,000 disappear from your retirement. Now, some of you are like, that's $220,000. It's not a big deal. This is why I'm making a big deal about it, because money is so relative. It's so stinking relative, right? For one person, they say it's just 22%, but maybe they have a $10,000 account. They're like, it's a couple $1,000s. It's not a big deal. But for another person, they have $1 million, and $1 million represents $220,000 of drawdown. My question for those of you with $1 million, are you okay watching $220,000 just disappear and then come back? Like, is that an emotional roller coaster you enjoy? And if it is, then great. It's great for you. You should keep paying $20,000 a year in money management fees to have somebody else take you on that roller coaster, because that is clearly an adventure that you love. But for the majority of people, we don't like that kind of adventure. For the majority, it could be as easy as saying, okay, the trend is reversed. I'm getting out and I'm going to sit in a cash safe position until I get signals to jump back in. Why wouldn't we want to do that? I don't know. That's just how I trade it. That's how I approach the market. Okay. So here's some key takeaways for today. Number one, buy and hold, in my opinion, is very painful. Number two, simple timing tools will help you avoid the pain. Simple timing tools will help you avoid the pain. Number three, you absolutely can beat the so-called professionals. And in my opinion, it's absolutely worth the time to learn how to do it yourself. Now, am I biased? I'm probably biased because I've been doing that for 26 years and I've been teaching people for the last 16. So yeah, I'm biased. I think this is the way that people should approach the market. But here's what I also know. I also know that I did not take a 22% hit in the last month, and my students didn't. Some of my students have even made profit on the bearish side because they've been positioned for that. Now, I will say, in fairness, there has been, there have been some trades that we thought were going to take off, and we thought maybe it was time. We got some signals, and then we whipsawed out of them. We got stopped out for a loss. It's been a relatively difficult first part of the year, but we haven't had a 22% drawdown. And that's the important thing. We're avoiding the pain. Now, have we been sitting here raking it in this year? I'm going to be honest. No, it's been a relatively rough beginning of the year, relatively speaking. But again, avoiding the pain. Which one's more important to you? Most human beings will do more to avoid pain than to gain pleasure. And that's why they end up never doing anything, because they're so afraid of the pain. And what I'm giving you here is I'm giving you some tools and some techniques that will help you stay away from some of the pain. All right. So that's what I got for you today. Now, tomorrow, for those of you who come back tomorrow, I'm going to share with you a retirement strategy, how we take this very same principle and we can apply it to your retirement accounts using ETFs. And you're really going to love this strategy. You're going to really love this technique. So if you've learned something, like and subscribe so you can come back and see me tomorrow. Follow me if you're over on Facebook or Rumble. Follow, I think it's what they call it instead of subscribe. And if you got any questions, please feel free to reach out, trademaestro.com. Emails help@trademaestro.com, help@trademaestro.com. Thank you for being here. I wish you the best. Let me see if I got any questions I need to answer. Bill says, what if I buy low because it looks like a great entry point and then it keeps going lower and lower? Now what? Well, Bill, that's why you have to wait until it's back into confirmed bullish territory. That's the whole point. The point is that, just because it is low doesn't mean that it can't go lower. And that's also why we use risk management tools like using our stops. So we can protect ourselves from further damage if things don't play out the way we thought they would. Let's see if we got any comments over here. Questions, none over there. No questions over here. Let's check. Where did it go? There it is. All right, so I don't think I have any other questions in here that I need to address. So thank you, everybody, for being here. I do wish you the best. I hope you have a wonderful afternoon. And like I say, tomorrow we're going to be getting into kind of a more retirement management piece of this that you can do on your own. You can save that 2% and you can manage it yourself. So mark your calendars and be here tomorrow, same time, same place. And until then, I wish you the best. Happy trading, and we'll talk to you soon.